Welcome back, everybody, to the Daily Energy Markets podcast, Monday morning, January 17th. Happy New Year to Omar, to Andrea and Peter from Sydney through Dubai and on to Europe on the doorstep of Peter McGuire, CEO of XM Australia, who clearly isn't getting long in the tooth, always looks fresh and just off the beach. Peter, the big sort of data points out of China this morning, the growth rate for the year, pretty big, bigger than I would have thought, over 8%. And for the fourth quarter, a little bit above expectations at 4.1%, but still a question mark over China, but nonetheless growing in a way that sort of defies all the odds.
Absolutely, Sean. Good morning to everyone. Greetings from Sydney. Yeah, no doubt. That 8.1, when it hit at around about 1:15, I just saw the line and it was like boom. I think it hit everyone by surprise. So it was an incredibly strong number. As you mentioned, 4.1 over the last quarter. But that overall number for 21 is extraordinary. So the story coming out of China is one of solid growth, export-driven economy, domestic demand, all of those numbers. We're conscious of it. Have a look where inflation is and conscious as far as, the global appetite for energy, what's going on with equities, building on what Omar mentioned as far as do we see a reversal sometime with some of those commodity prices. The iron ore price, copper was bid up and then it was spanked down Friday night. So Sean, I think volatility is going to be the name of the game over the first 3 to probably 4 months.
When you look at the rate cut, China cut its rate on policy loans, as it's called.
Yes.
Again, you're reading into that. They're still willing to support the market there.
Well, they have to, Sean. I think the fear factor as far as the evergreens and the other property sectors, we're conscious as far as the behemoth in the room, the $62 trillion industry being property. And if these big cards fall, the lead up to Lunar New Year, I think they're just trying to, massage that, get us over the line, and naturally with the Olympics. So if they can walk through here without a major bust, and that's the big question mark as far as property, then that's why I'm saying the first 3 to 6 months could be very electric.
Well,
let's go, Peter, on that point. Welcome your thoughts, because another big narrative as we start the year is that exact issue. Where are the monetary policy makers going to go? Most notably the Fed. We've very quickly gone from a few months ago, no rate hikes in 22 to now 4 is the current narrative. We're not seeing it giving much support to the dollar. Your thoughts on where that monetary policy is going to set the tone this year?
Well, I think a lot of that was already baked into the dollar, Sean, and we had that nice run up to the 96, 96.2, and then a little bit of that hot air came off it. We're sitting at 95.3. So I think the momentum, I wouldn't be surprised to trade down as far as that high 94s, and then all of a sudden after March and when we get the first cab off the rank, and as you mentioned, possible 4, and I've heard some analysts say you could even see 5 this year. So I think the momentum's going to be strong for US dollar, and I wouldn't be surprised to see it bounce to the upside. I'm not sure how far further it'll go, whether it's through a 96 or even to a 97 handle, but who's to say it could happen if you get successive quick moves. You've just got to see where Powell plays. And if he plays by mid-year and you've had 3 rate rises by July, then it's really game on leading into that, second half of the year, Sean.
Would that qualify, given that outlook for the year, Peter, as the Fed losing control of inflation, that they're now chasing the horse rather than riding the horse, if you like, in that 7% print on inflation last week is a very, very serious number, and the threat that is to much of the economic recovery. I mean, in the past, when we've had to accelerate interest rate recovery, it's led to recessions.
Yes, absolutely. And to the point, nearly, the stagflation stories, high inflation or reasonably high inflation and, poor growth. So we've just got to see where that runs over the next 3 to 6 months. If it gallops away to an 8 or a 9 or even a 10 handle, you've only got to look at the price of stud lumber, look at the price of the input costs for building, what you're paying as far as food in the States, and certainly I feel it in Australia. I caught up with a dear friend last night, and he'd been up the coast to see his dear father of 98, and he filled the car up on the way down at $2.01 a litre for petrol, which is nearly unheard of, Sean, in Australia. So there you are, 4.5 litres to the gallon, and that's nearly $9 a gallon, which is extraordinary value as far as Australia is concerned. So we're really feeling it in the purse. We're feeling it in the wallet, and that no doubt will continue, I think, over the next many months. And if energy prices, as many analysts, again, the big banks are saying $100 or $120 handle, the winner's going to be the producer, Sean.
And it's going to show up at the election polls as well, including the most notably the US midterm elections. If the trend line stays at current inflation rates, hold on to your hats. Let's get the survey result. Give Peter the last word out in Sydney. Omicron is no longer relevant as far as the oil markets are concerned. 81% of this room agree. Peter, I'm not going to ask you who's going to win the Australian Open that starts today. We know it's not going to be Novak Djokovic for the first time in many years. But your thoughts, Peter, looking to the week ahead and to the year ahead, and where those two come together. We're seeing some guidance on central bank policy this week out of obviously China, Japan.
Absolutely, sure. Well, I'm keeping a close eye on the BOJ and what the storyline is there. We've got unemployment, as you know, sitting at around about 2.2%. So that's a fairly good number. But we've got we've got the Tankin survey, which was becoming more confident, that's another good sign. But consumption remains weak. We know that there's wage growth that's anemic. So putting all of that into some context, I'm not expecting any stars to shine for Japan in the short term, but it's going to be a great trade to keep an eye on that yen. As far as where we go, I don't want to go much further out than say the first 4 to 5 months, because you've got Fed, you've got what's happening with the UK, what's happening with numerous elections starting to roll, naturally Australia's elections in about May. So everyone's got a close eye as far as politically where the game is, equities, what's happening with the NASDAQ and so on. So all I'll say is this, Sean, hold on to the wheel tightly, because I think we're going to be in for one bumpy ride.
We've seen in the past, Peter, just quickly wrap on the when we go into a tightening cycle, rates rise on the dollar, Fed rates rise. That has been bad for Asia. Your thoughts on this cycle as we go into a tightening? What is the outlook for Asia?
Well, it's a hard one to know, because we've got, first off, we've got big infrastructure spends that a lot of Asia has embraced. And as it comes out of, if you look at the likes of the Philippines and the Vietnams, Thailand, Malaysia, Indonesia. But if you look at the other side of it, of course, as you mentioned, what are these economies? How are they going to perform after the first, 3 to 6 months? So I think it's going to be, again, volatile. I think a lot of the smart money will look at those mature markets and certainly hunt for bonds, and possibly, the US is the place to seek shelter. But the inflation story, I think, is going to be one of much concern for many of the investors, certainly across Asia. And I think it's just going to be a volatile time, Sean.
Let's wrap it up there. Andrea, lovely to have you back. Peter as well, Omar as well. Really appreciate your engagement. Happy New Year to everybody. Best of luck navigating these volatile markets. Catch up with you every morning, 10:30 here on the Daily Energy Markets Podcast. Thank you.
Thank you very much.
Thank you.